The IRS just handed a lot of retirees a bill for 2026, and most of them do not even realize it yet. People walk into retirement thinking the tax pressure will ease up. They assume the hard part was earning the money. They assume the government stops leaning on them once the paycheck stops. In my experience, that is one of the most expensive assumptions a person can make. I have watched people spend decades building savings only to lose thousands of dollars in retirement because they misunderstood timing, brackets, deductions, and the hidden taxes that show up after the obvious taxes are done with you. The pain usually does not come from a market crash. It comes from bad sequencing. It comes from reading the headline and missing the math, and right now the math has changed. The IRS released the new 2026 bracket framework, and when you combine it with the One Big Beautiful Bill Act, the game in retirement is not what most people think it is. Some people are going to use these new rules to protect a large piece of their income. Other people are going to walk straight into stealth taxes, Medicare cliffs, and deduction phase-outs they never saw coming. I want to walk you through this the way I would if we were sitting across from each other with a yellow legal pad and a calculator. No theatrics, no fluff, just the numbers, the pressure points, and the few moves that actually matter. Most financial stress in retirement does not come from not having enough money. It comes from not understanding how the money gets counted. That distinction matters more than people think. A retiree can have a decent nest egg, no debt, a manageable lifestyle, and still feel squeezed every year because the tax code is quietly reaching into 3 different pockets at once. It taxes income directly. It phases out deductions, then it comes around the back door through Medicare premiums and Social Security taxation. Most people only notice the first hit. The other 2 are what I call the hidden hands. So let me start with the new baseline, because without the baseline, the rest of the strategy is just noise. For 2026, if you are married filing jointly, the standard deduction is $32,200. If you are single, it is $16,100. If you file as head of household, it is $24,150. Those are meaningful numbers on their own, but they are not the real story. The real story is the new senior bonus deduction. If you are 65 or older by the end of 2026, you get an extra $6,000 deduction. If both spouses are 65 or older, that becomes $12,000 straight off taxable income. Now, this is where people either get protected or get confused. A lot of retirees hear about a bonus deduction and think about it like a little coupon. It is not a little coupon. In many cases, it is a shield, and if you stack it correctly with the rest of the rules, it changes the shape of your retirement income far more than people expect. Let me slow this down and build the stack the right way. If you are a married couple, both 65 or older, filing jointly, you start with the regular standard deduction, then you add the senior bonus deduction, then you add the additional age deduction. When you stack all of those together, your total deduction becomes $46,700. That means a married couple can protect $46,700 of income before federal taxable income begins to bite. That's not a small detail. That is a major line in the sand. If you are single and 65 or older, your total shield becomes $24,050. Again, not trivial. The reason I call it a shield is simple. In retirement, every dollar you can keep out of taxable income does 2 jobs at once. First, it directly lowers what you owe. Second, it reduces the chance that other tax mechanisms start waking up and feeding on the same income stream. A lower taxable base can help you preserve more of your Social Security, keep you farther away from Medicare surcharges, and reduce the risk that a one-time decision turns into a 2-year problem. But this is where I want you to stay alert, because the government rarely gives something away without attaching a wire to it. This senior bonus phases out. If you make over $75,000 as a single filer, the IRS starts taking the bonus back. If you make over $150,000 as a couple, they start taking it back there too. This is the part that hurts people who think in broad strokes instead of exact numbers. They hear that there is a senior deduction and they relax. They hear that there is relief and they assume they qualify in full. Then they drift over the line and discover the relief was real, but only for people disciplined enough to stay under the threshold. That is why retirement planning is not about whether a rule exists. It is about whether you can live in the narrow lane where the rule actually benefits you. Now let me move to the part that catches retirees emotionally, because it deals with Social Security. And very few people like hearing that Social Security is still part of a tax puzzle. The rules for taxing Social Security did not change. The math did. And that is the difference that matters. Most people keep asking whether Social Security became tax-free. That is the wrong question. The better question is this: how much of the rest of your income can you arrange so that Social Security gets washed out by deductions before the tax bite really lands? That is the opportunity. The new senior bonus creates what I would call washout protection. It does not magically erase taxes for everyone. It does not make the problem disappear. But it gives some retirees a larger buffer zone where taxable income can get neutralized before it does real damage. That sounds technical, but it is really not. Here is the plain English version. You can still have up to 85% of your Social Security tax depending on your income. That basic rule remains in place, but if your deductions are larger, more of that income can be offset before it does real damage. In other words, the same Social Security benefit can feel more or less taxable depending on what else is sitting on the return and how cleanly the deductions are stacked underneath it. That is why I keep saying retirement taxes are about structure, not just size. Now let me show you where the trap is. For every dollar you earn over the threshold, you lose 6 cents of that senior bonus deduction. That sounds small, and that is why people underestimate it. They say 6 cents is nothing. That is the wrong way to think. One leak in a pipe does not scare anybody. What scares me is when the leak is connected to 3 other pipes and all of them start dripping at once, because once you lose part of the bonus deduction, you may also raise your taxable Social Security exposure. You may also increase the chance of pushing into a Medicare premium cliff. You may also affect other deduction planning decisions down the line. One small overage can start a chain reaction. Take Jane. Jane is 67 and single. She has $80,000 in total income. Because she is $5,000 over the limit, she loses $300 of her bonus deduction. By itself, $300 does not sound like the end of the world, but retirement is not wrecked by one dramatic number. It is usually eroded by a series of seemingly harmless overages that stack on top of one another until the total becomes real money. A small loss of deduction here, a Medicare bump there, a little more Social Security taxation than expected, and before long a retiree who thought they were operating in a clean tax year is giving up meaningful cash flow for no good reason except bad planning. That is why I want you to stop thinking about taxes as an annual filing event and start thinking about them as a sequence management problem. Now let me move to something that matters enormously if you live in a high-tax state, own property, or have been suffocated by the old SALT limitation. Since 2018, many taxpayers have been trapped by the $10,000 cap on the state and local tax deduction. That cap was brutal. If you lived in a state with high income taxes or high property taxes, the deduction barely reflected reality. It was like being told your expenses existed, but only the first slice of them counted. In 2026, that cap jumps to $40,400. That is a major change for the right household. That is not a minor patch. That is real relief. It is especially meaningful for homeowners who have been paying serious property tax bills while watching the federal deduction system pretend those bills were somehow modest. But here again, the government does not give relief in a straight line. If your income is over $55,000, the IRS reduces this relief by 30% of everything you earn over that limit. So yes, the cap explodes higher, and yes, that is good news. But no, you do not get to assume the full benefit survives untouched. This is why people who celebrate tax law changes too early often end up disappointed. They hear the headline, they skip the mechanism. The mechanism is where the truth lives. The good news is that you will always get to deduct at least $10,000. The better news for business owners is that the pass-through entity tax workaround is still alive. That means for some people, especially those with the right business structure, There are still ways to bypass the cap entirely. That is not a universal answer. It is not for everyone, but it is a reminder that people with structure usually get more options than people with none. That has always been true. Now let me take you to the trap I think frightens retirees the most once they finally understand it, because it comes late. It feels unfair. And it often arrives based on income you no longer even have. I am talking about Medicare IRMAA. This is the bomb that goes off 2 years after you light the fuse. Most people do not understand that Medicare uses a 2-year look back. That means your 2026 Medicare premiums are being set based on your 2024 tax return. Think about how absurd that feels to the average retiree. You can have a completely different life in 2026 than you had in 2024. You may have retired, you may have lost a spouse, you may have sold a business, converted an IRA, taken a one-time income spike, or simply had a year that does not remotely resemble the present. And yet Medicare looks back 2 years and says, this is who you are. That is how people get ambushed. They make one decision in 1 year and then get punished later by premium surcharges. They never connected to the original event. That is why I call it the Medicare cliff. You do not feel it while you are approaching it. Then suddenly you are over it. And in some cases, the surcharge can effectively double what you are paying monthly. That is real money, not theory, not spreadsheet theater. Real money leaving your pocket because the system is slow, mechanical, and absolutely indifferent to your current reality unless you force it to look again. So what do you do if you are retired now, or if you lost a spouse, or if your income has genuinely fallen from what it was 2 years ago? Do not just sit there and pay the bill like it is untouchable. File Form SSA 44, immediately tell the government your income has dropped, make them reassess. A lot of people treat government notices as final. They are not always final. Sometimes they are simply unchallenged, and unchallenged numbers become expensive numbers. Now let me tie all of this together, because this is where most people lose the plot. They hear about brackets, they hear about deductions, they hear about SALT relief and Medicare and Social Security, and they start treating each one like a separate puzzle. That is the mistake. These are not separate puzzles. They are one machine. A retirement tax return is a machine where one lever moves another lever, and then another one after that. If you only look at one part, you can miss the chain reaction. That is why proactive planning is no longer optional. It is the difference between preserving your savings and quietly handing them back to the IRS in installments you barely notice until the year is over. So if I were organizing this for myself or for someone I cared about, I would reduce it to a 4-step action plan. The first thing I would do is audit income, not estimate it. Not vaguely think about it, audit it. I would know exactly where total income lands relative to the senior bonus thresholds. If you are single, that means understanding where you are against $75,000. If you are married, that means understanding where you are against $150,000. Not because those numbers are magical, but because crossing them carelessly can start taking away a deduction that was supposed to protect you. The second thing I would do is defuse the Medicare bomb. I would go straight to the 2-year look back and ask one question: is the income Medicare is using still economically real in my life today? If the answer is no, then I would not passively accept the premium schedule. I would challenge it with the proper form and the proper timeline. The third thing I would do is maximize the SALT strategy if itemizing makes sense. A lot of people stop thinking seriously about SALT because the old cap made the exercise feel pointless. That mental habit can be expensive. Now, if the cap is higher, the old assumptions may be wrong, and if you own a business, the pass-through entity angle may matter more than you think. The fourth thing I would do is use income shifting where appropriate. That can mean Roth conversions, that can mean qualified charitable distributions, that can mean donor-advised funds. The point is not to use every tool. The point is to understand that income timing matters just as much as income size. The person who controls when income shows up often pays less than the person who only focuses on how much there is. That is one of the oldest truths in tax planning, and it is one of the least understood by retirees who have spent most of their lives inside payroll systems where timing was largely decided for them. Retirement changes that retirement hands the steering wheel back to you. Some people are thrilled by that. Most people are not prepared for it. But whether you are thrilled or not, the responsibility is still yours. That is really what this comes down to. The 2026 tax cliff is not just a technical event. It is a test of whether you are going to drift through retirement under old assumptions or whether you are going to recognize that the tax code changed and move before the hidden hands start taking their cut. The people who get hurt will not usually be the poorest retirees. It will often be the ones with enough money to trigger phase-outs, surcharges, and partial taxation, but not enough margin to ignore them. Those are the people who need to pay attention now. So here is the simple version. Know the new baseline, respect the senior bonus, but do not assume you keep all of it. Use the washout math where it protects Social Security. Revisit the SALT deduction. If you own property or live in a high-tax state, do not sleep on IRMAA. And above all, stop treating retirement taxes like a passive paperwork exercise. It is not paperwork, it is strategy. The government just changed the board for 2026. You can either keep walking forward with the old map, or you can adjust now and keep more of what took you a lifetime to build. That choice is still in your hands. And in retirement, keeping control of that choice is worth more than most people realize.